Joining me now in studio is the CEO of Mayibuye, Johan Meiring, and he's here to talk us through the complex financial transaction that involves Blue Financial Services. Welcome, Johan.
Hi, Jane.
This is a complex transaction. What are the key aspects to it?
Jane, there's three key aspects to the transaction. The first thing is Blue's liabilities exceeds its assets. So the first thing a person has to do is to try and ring fence the past, to try and make sure that there's no overflow from the past going into the future. In other words, that insofar as a person invests new money into the company and new shareholders come into the company, they don't have to pay the penalty of mistakes of the past. So in other words, the first step in the transaction is to ring fence it, whereby the existing funders' claims are limited to the existing assets in the business. And then there's an entire structure around that. The second part of the transaction is to recapitalize the business to move from a negative equity position to a positive equity position. And the third part of the transaction is to raise funding for Blue on a basis acceptable to the new funders.
Johan, tell us a bit more about the debt rescheduling agreement. What does it actually entail, and how does it match the liabilities to the assets?
The debt restructure or debt rescheduling agreement, what it does is it takes the existing liabilities and ring fences it to the existing assets that was created with the liabilities. So the effect of it in essence is that for a 3-year period there's no capital repayments that happen on these liabilities, which provides an opportunity during the 3 years for debt recovery actions to take place on trying to rehabilitate some of the assets that's gone bad. And secondly, by utilizing the capital of loans as and when they are repaid, to on-lend again to make an additional margin on that, which all in essence help to build up the asset. If during the entire process the asset and the liability can't be matched because the gap may be too big, then in that circumstances there's a conversion of debt to equity by existing funders.
What would the dilutionary effect be of that?
Well, there's three parts to it. I think the first entity that is diluted by this is Mayibuye Group, because we, at date of subscription, we would have 60% of, a little bit more than 60% of Blue. If there's approximately, if I take a number of a 300 million rand conversion, we in essence get diluted from over 60% to at 51%. Because in terms of the agreement, for any debt to equity conversions for funders, we can't be diluted below 51%. But it does imply that we get diluted first. And you should take note that we're the only people that's put money in. So we in essence put money in and we get diluted on top of that. Then in the second instance, the funders will get diluted, and then only shareholders will get diluted. So yes, there is a dilutionary effect, but I think the dilution is shared between the respective stakeholder groups.
All right. Have the funders bought into your turnaround strategy?
Yes, the majority, in excess of 90% of the funders representing outstanding value, has signed a formal agreement. You may appreciate that it's taken a considerable period of time to negotiate this transaction, but they're fully supportive of it now.
What new funding does this transaction then make available?
There's two legs to the new funding that is made available. In the first instance, it's the 163 million of capital that is being invested in the business, which is available for the normal business of Blue. And then secondly, there's another 300 million that's made available through a claim purchase agreement. Now, the claim purchase agreement, in essence, is just a structured financial transaction to make 300 million rands worth of funding available to Blue, but on a basis where the existing funders do not have to take any risk in relation to the solvency of Blue.
All right, and can you tell us a little bit more about how the claims purchase agreement is actually structured?
It's structured on a basis whereby Blue would do lending as per normal to originate its loans. It would then sell those loan claims through to a insolvency remote vehicle, and then share in the excess spread or margin that comes from it. But the advantage for Blue is that they wouldn't have capital risk once a specific loan claim has been sold.
All right. What is the new funding going to be used for, Johan?
It will be used for the business of Blue, and not only to expand the business of Blue in South Africa and others build up the new loan books, but also throughout the different countries in Africa where Blue has a presence.
All right. Tell us a bit more about your turnaround strategy on the operational side.
The turnaround strategy is multifaceted, but the first thing is we need to get the cost down because Blue's costs were, I think, possibly too high. Considerable progress has been made, and we currently got the cash cost of the business down to less than 23 million rand, and our target is to decrease that by another 3 million rand in the foreseeable future, and we're quite positive that we'll achieve that. And the second thing is we need to get the credit process working on a basis whereby provisions can go more to an acceptable level on a reference to one's peer groups and not at the current levels where the provisions are sitting.
And then, Johan, who's managing the various aspects of the operational side?
There's some aspects of the business in Blue that will be managed by some of the existing investments that Mayibuye Group has. Some of these investments is Poloza, which will involve itself on the debt collection aspects of it. And then there's another one of our investments, Viedge, that will get involved in assisting Blue on the credit approvals and management generally of their portfolios. I think the one thing that we would like Blue to concentrate on is on the sales and the expansion of its business and acquiring new clients, whereas some of the other investments that Mayibuye Group has, core focus and skill sits on credit management and credit recovery.
So it's very important that you're getting Blue Financial Services to refocus on certain aspects of the business.
Absolutely. It's a question, I would like them to focus on attracting new customers, servicing its existing customers, and build up a reputation for that, but to blend that with the skills that already sits in other investments that Mayibuye Group has, so that a person can have the synergy effect between them.
What news is this for shareholders then?
I think it's good news for shareholders. At this point in time, I think shareholders lost the investment because the company pre the transactions got negative equity, and I think it's not certain whether it will survive. Post the transaction, the mistakes of the past have been ring-fenced, so people don't have to continually pay for that. And shareholders have the opportunity in sharing in a new business that is built with new customers based on existing investment.
Great. CEO of Mayibuye, Johan Meiring, thanks for joining us.
Thank you very much.